The lights are still on. Your bank app still loads. Your portfolio still shows numbers. And then one morning, it doesn't matter. Because in a real economic collapse, price and value split apart. Something can have a price tag and still be worth nothing. Let's talk about 5 purchases that quietly die when the system breaks. Not because they're bad, but because they depend on a world that no longer exists. This matters right now because modern wealth isn't built on objects. It's built on systems, credit systems, energy systems, legal systems, digital systems. And systems fail faster than people expect. Number 1, highly leveraged real estate. On paper, property feels safe, solid, physical. You can touch it. During normal downturns, housing dips 10%, maybe 20%. But in severe collapses, leverage turns against you. In 2008, U.S. home prices fell roughly 30% nationally. In some cities, over 50%. That wasn't the scary part. The scary part was this. Most owners only had 5 to 20% equity. Do the math. If you put 10% down and the property drops 30%, your equity doesn't shrink, it vanishes. You're underwater. You own nothing. The bank owns an asset worth less than the loan. The house still stands, but your stake in it? 0. Number 2, speculative growth stocks with no cash flow. During expansions, investors buy stories, total addressable market, future dominance. Profits can wait. In a collapse, profits can't wait. When credit tightens, money becomes expensive. Companies burning cash need refinancing. If they can't get it, they dilute shareholders, or they disappear. In 2000, after the dot-com bubble burst, the Nasdaq fell nearly 78% from peak to trough. Thousands of companies never came back. Their shares didn't just decline, they went to 0. The uncomfortable mechanism here is simple. If a company doesn't produce cash, it survives on confidence, and confidence is the first thing to evaporate. Number 3, luxury goods bought as investments. Designer watches, limited sneakers, high-end collectibles bought at peak hype. In normal times, scarcity plus status equals resale value. But during crisis, liquidity disappears. When people need rent money, they don't bid on limited editions. Markets for discretionary items freeze. Prices gap down. The buyer pool shrinks to almost nothing. Value is not what something meant last year. Value is what someone will pay today. And during collapse, buyers are busy surviving. Number 4, cryptocurrency purchased purely on momentum. Crypto isn't automatically worthless, but assets with no intrinsic cash flow rely heavily on narrative and network confidence. When risk appetite is high, liquidity floods in, prices soar. When fear spikes, liquidity reverses. In 2022 alone, the total crypto market lost over $2 trillion in market value from peak levels. Some tokens fell 90%, many never recovered. The hidden math is brutal. If an asset falls 90%, it must rise 900% just to break even. That's not volatility, that's structural damage. Number 5, businesses built entirely on cheap debt. For over a decade, global interest rates hovered near 0. Money was cheap. Companies borrowed aggressively. Share buybacks boomed. Zombie firms survived by rolling over debt. But when rates rise sharply, debt payments reset. If revenue doesn't grow at the same pace as interest costs, margins collapse, credit ratings fall, refinancing becomes impossible. The business may still have customers, employees, offices, but equity holders? Wiped out. Here's the system underneath all 5 examples. In stable times, liquidity masks fragility. Easy money props up valuations. Low rates justify high prices. Leverage amplifies returns. In collapse, the process runs in reverse. Liquidity drains, leverage magnifies losses, confidence cracks, and anything dependent on constant growth or refinancing gets exposed. It's not that these purchases are always foolish, it's that they are conditional. They work beautifully inside a functioning financial ecosystem. But if that ecosystem contracts hard enough, their value isn't reduced, it's erased. And that's the quiet irony of modern wealth. The more abstract and leveraged the asset, the more impressive it looks during booms, and the faster it can disintegrate when the system tightens. So the real question isn't which asset is trendy, it's this. If credit freezes tomorrow, who is still willing and able to buy what you own?